Last week, we dug into how much life insurance should you actually have. That was an interesting topic. Be sure to check that out. This week, we're talking the guarantees in whole life and IUL. They're a bit different, and we're basically going to highlight the main things because there's probably a million guarantees if you dug through the actual contracts. So we're just going to highlight the big ones that you should know about. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with Net Wealth Finance.
All right, guarantees. Obviously, whole life, the backbone of whole life. And the reason it's such a great product to own for many people's financial plan is the guarantees that it provides, which is much, much more than we get in an index universal life insurance. What are some of the big guarantees that we get in whole life?
So in this space, one of the main things that you will hear about is that guaranteed growth that comes along with whole life. And that actually connects to another thing, which is that guaranteed death benefit. So those are a couple of big guarantees that are in whole life, assuming you pay your premiums, obviously. But those are some foundational elements of the guarantees within whole life.
Yeah, and that death benefit that you start with, whole life has a base amount that when you make that payment, it's guaranteed to equal that death benefit at maturity. And that falls in line with that growth guarantee. Prior to 2021, the guarantee was 4% on every whole life product. After 2021, now we see a range between 2%, even up to 4.5%. That doesn't mean you're not going to earn more than that, but the guaranteed part of it, it will get there.
The guaranteed rate is that guaranteed growth rate, and there are dividends that are called the surplus dividend that is in excess of that guarantee. So when they declare, an insurance company declares a gross dividend rate, it'll be that gross rate, and the guaranteed rate subtracted from that will give you that surplus dividend. And so that part is not guaranteed.
That part's not guaranteed, but when it pays out that dividend becomes a guaranteed death benefit. It turns into an amount of cash value, and then it's going to get that new guaranteed growth. So every time that dividend does kick out, it now becomes a part of that guaranteed part of the policy that they can't take away.
And that's really that you'll see it as a column and that guaranteed cash value as well, which is connected to that. And in the end, assuming you're doing the purchase of those paid up additions as well with that dividend, you will continue to see this snowballing effect with that guaranteed growth.
Yeah, I painted a picture of this in one of our earlier episodes where it's like a tree. You've got the base part of your policy that is the tree trunk, and every time a dividend pays out, it's growing a new branch. And that new branch is going to kick off dividends, and those dividends are going to be new branches off of that branch. And it's just going to keep growing just like a tree, and it'll start growing in all the directions. That's your compounding growth. It's not just one thing growing. It actually paints a very good picture on how these things end up working.
Yeah, and I think it is really powerful. And so some of those elements that we've discussed here are why so many people in this space are all about whole life, because it really has the strongest guarantees.
Now, beyond the guaranteed death benefit and the guaranteed growth that's going to happen to get us to that death benefit, you have the guarantee of knowing that that base amount of insurance that you have to pay is all you ever have to pay to ensure that that policy will never lapse. So having that guarantee that says if you just continue to make this premium payment, your policy will last until you die, that's a pretty powerful guarantee also.
And that is a pretty big contrast to the IUL, which it does not guarantee that. So it is powerful to have a guaranteed amount that for the rest of your life, if you want to pass on that death benefit, you can pay that base policy amount and you will have a death benefit that is passing on.
Absolutely. Now, another part that's guaranteed is the ability to access the cash value of your policy. All of these life insurance policies, the permanent policies have a cash value that represents the current value of the future death benefit. You have your cash value, it is going to grow to be that death benefit at some point, and the government said you have to make that available for loans to your clients, and that is contractually guaranteed.
And there is that contractual guarantee to access in, like James said, in all these cash value. So that is also available in IUL, and these loan structures will tend to be guaranteed. Even if it's a variable loan, they'll have some kind of guaranteed structure that is tied to that loan that you're able to access through.
Yeah, these policies will generally either have a guaranteed fixed rate or there might be a variable rate, but you have a guaranteed maximum that they can charge. Now, we don't want to jump into all of the various little guarantees that are available inside of a whole life policy, but let's just kind of run through just some of the smaller ones before we move on to index universal life.
Not all policies will have all of these things, but there are things like terminal illness, chronic illness riders that are guaranteed, that give you a contractual guarantee to access those funds if you meet certain criteria, like a terminal illness or a chronic illness or a critical illness. There's different types of these things that are available depending on the policy. And sometimes that's tied to if you have a big enough base policy to get access to some of those accelerated death benefit riders.
Yeah, and there's a whole host of riders that people can add that do add to all of the guarantees that are available in these policies. You could have long-term care. You could have a guarantee ability to be able to purchase additional insurance. You could have guaranteed coverage on kids. You could have a guaranteed waiver of premium. The list goes on when it comes to the different riders that are available, and some carriers will have additional riders that other carriers might not have. There is a unique rider that's available in not very many whole life policies that we'll see on the index universal life side, but some of them have a loan protection rider, which also gives a guarantee that as long as you meet the requirement, usually at 65 or 75 years of age, if you borrow a certain amount of money out of your policy, if you trigger that rider, you can essentially walk away and the insurance company will maintain a small death benefit until you pass away so that your policy doesn't lapse. We call it the loan protection rider because that's usually the case. If you accidentally or on purpose, you decide to borrow almost all of the cash value out of your policy. And it's usually a fee of somewhere around 5%.
And what that really is protecting you against is a gigantic tax liability. And it's really helpful, and it's more common on the IUL side, but there are some whole life products that do have that as well. And the thing that could happen is if you didn't have that and you borrowed too much, where you've tapped too much of those gains and you lapse the policy, then you could be hit with a tax bill when you lapse that policy.
And on the whole life side, to wrap up this, there are some guarantees around paid up additions. When you have a paid up additions rider, you're guaranteed to be able to just add some extra money as long as you're meeting the qualifications of that rider so that that rider doesn't go away. And when we do our blended designs, you might have an increased guarantee on the ability to contribute paid up additions.
Yeah, and you should also have a guaranteed premium load fee for those paid up additions, that paid up addition fee that is tied to that.
All right, let's move on to the IUL. This one's going to be a little shorter. There is not as much guarantees when it comes to the IUL. What do you get from a guarantee for the death benefit?
Well, you do have a guaranteed death benefit, but the costs that are involved to get to that are not guaranteed. Those costs can rise drastically as you get to older age, and that is something that could really impact whether or not you could afford that life insurance in the future.
So let's break that down just a little bit because there are cost guarantees that can get you that death benefit, but the guaranteed amount that you have to pay is a lot higher than the current rate that you're going to be quoted and that your policy will start out at. There's a current cost of insurance and then a multiple higher of that. That's the guaranteed cost of insurance. But ultimately, when you first start your index universal life policy, there's a minimum amount that meets a no lapse guarantee. But that no lapse guarantee, as long as you put in that minimum amount, might only last for 5, 10, 15, or 20 years.
Yes, and then that's why when we talk about IUL, we tend to say we want to fund them strongly so that we can have enough cash value to ensure that we're covering those expenses at least.
So, along with that, you don't have a guaranteed small amount like we do in whole life that says, as long as you keep paying this minimal amount, you will have a death benefit until you die. No, your policy could lapse in the case of an IUL. Now, in the event that you have a policy that you're max funding, there's 0% chance that that policy will lapse if you max fund a policy as long as you're able to, which is like age 99. But nobody really buys an IUL with a plan to max fund it until age 99. And so there ends up being this technically questionable period. Did you fund it high enough that you're going to be able to still have that death benefit around as long as you need it to be?
Yeah, and I think that is the big difference in the structural difference of universal life, which IUL is built on top of, and whole life. So it's important to really look at how you're planning to fund this and try to get as close as possible to max funding an IUL.
Now, the reason for this, the reason why your policy could potentially lapse is because that minimum amount that you're required to put in doesn't come with a growth guarantee. The guarantee on growth in an IUL is essentially zero in almost every IUL. You might have some that have a small floor, or you might have a bonus that may or may not be guaranteed, or you might have a bonus that has a small guarantee. But that guarantee, which generally caps out around 1%, may not be enough to keep your policy from lapsing. So when we think about the guarantees in relation to whole life has a guaranteed amount. As long as you pay it, it will keep that policy active. But there's no telling if that small guarantee that you might get in an IUL will be able to keep it active.
Yeah, the IUL guarantees are not related to a guaranteed credit so much as maybe that when you have a bonus that might be like a 1% bonus, that is not going to be guaranteed to maintain the policy, as James mentioned. So really, we're looking at having some good gains in order to ensure that the health of that policy and potential gains are very high, but they're not guaranteed for the most part. However, there's also oftentimes some kind of guaranteed bonus structure that you might have access to in these different indexing strategies. And those will be in the contract if they are guaranteed.
Yeah, so some of the other things that we do get that do have guarantees in the IUL, you have a guaranteed participation rates. There's a minimum amount of participation rate in every index. You have a guaranteed cap rate if it's a capped product. You have a guaranteed spread if it's a spread product. And there could be some guarantees on the amount of bonuses that you have available. Now, these can vary wildly.
Yes, it really depends on the products that you're in and one of our favorite products, the guaranteed participation rate is only 5%. And what that means in the net effect is if the underlying index does 10% and somehow they lowered it down to that 5%, you're only getting half a point of credit on that. So that is a thing that you got to keep in mind. Although the circumstances, I think we've had prior episodes where we delved into how that's a very unlikely scenario. So you don't really have to worry too much about that. But know that some of these different bonus structures and you might have multipliers and various other things that are involved in these things that will be written into your contract for these indexing strategies.
Yeah, as with the whole life, in the case of IUL, there's riders that can offer guaranteed other parts of a policy in relation to growth potential or additional coverage, things like that. And we're not going to dive into all of those things. We're covering the main guarantees, which essentially we've already covered those. There is not a whole lot of guarantees in there other than you are guaranteed to not lose money based on the market returns. That's where that 0% floor comes in. Sometimes people say zero is your hero in relation to the IUL. When the market's negative or the index option that you chose is negative, the worst you can do is zero unless you have one with a bonus that still gives you a credit above the zero. But that doesn't mean the cash value in your policy can't go backwards, because it can.
Yes. In an IUL, if you hit one of those 0 years, and let's say you are in a strategy that, or all of your indexing strategies are that 0% floor, well, you still have a cost of insurance. And if if your cost of insurance exceeds the amount of premiums you've paid in, then your cash value is going to go down in that year. So that is something to keep in mind as you are funding these. You really want to be a good bit of buffer above that minimum amount that you should be paying in, ideally max funding.
Well said. And there's a lot of reasons to get products that have really good guarantees, but guarantees do add to cost. And the appeal generally to the IUL is the flexibility in premium and the growth potential. So we do still like it, especially when it's a plan that entails both whole life and IUL, but it's also something that can be attractive on its own. So don't take this video or this podcast about the guarantees to say that we're preferencing one of these products over the other. Each one has its place in a portfolio. It just matters which one aligns better with your goals and your risk tolerance.
And I want to just add that one of the reasons we are okay with not having the guarantees in an IUL is, like, in my own IUL, I have had double-digit years. I don't really expect my whole life to ever really hit that. I think it's very unlikely. So that is a big strength, but it's not guaranteed. And over the long term, when you have some of those 0 years and some of these strong years, it's going to end up being, or it should, in my mind, the way that I view it, end up being a little bit higher return that I sacrifice those guarantees for.
The other thing we'll see is, with the proper designs, we're going to have a much lower expense ratio in that IUL than in whole life. And that's almost assuredly because we have lower guarantees in here. In whole life, they need to make extra money on the funds that you're giving them so that they can set those aside to help cover the costs later on when the costs would otherwise be increasing. We get to take advantage of paying the low expenses of the actual risk of insurance in the early years in the IUL and bank that money and grow it and compound it so that when that policy gets quote unquote expensive in older age, we've already grown enough cash value that we don't really care. And we can minimize that cost of insurance, or that increasing cost of insurance doesn't impact our overall financial plan at all. Any final thoughts before we wrap this one up, Carlo?
Well, I think that it's important to note, as we've kind of mentioned here, that the guarantees are not everything. And we see a place for both of these products in most people's asset portfolio. So it is something to consider. And we have lots of other content. We've gone through a lot of different reasons why we like one product or for different situations. But in the end, the best thing is to probably have a conversation so that we can understand your situation. So reach out to one of us if you're interested in understanding whether the guarantees are worth it, or you want that higher potential return, or whatever it might be. It's better for us to understand your overall picture financially.
And this is getting released on tax day here in the US, or close to it. So be sure to join us next week, where we're going to talk life insurance and taxes. Should be relevant, especially if you're a business owner and you've asked for an extension, which I know I do that every single year. So stay tuned for that. But I figure with tax day here, it's going to be on more people's minds. And next week, we'll cover life insurance and taxes. Thank you for joining us. I'm James Barber, your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
Take care. See you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.